A fast-evolving financial landscape in the US is changing how households and companies use cash, how they borrow, transact, and seek returns. As we take a closer look at the future of finance, one of the 5 mega forces we see shaping returns now and in the future, we're tracking the tectonic shifts that are underway in the US financial sector, changing the way people save and borrow. Over the past few years, deposits have been withdrawn from US banks at an unprecedented pace. But this isn't a bad news story. It's mainly because, with the Fed's rate hikes, savers have other options with higher returns. In September this year, money market funds were offering investors an average yield of 5% on their cash versus just an average of 3% that US banks were paying on deposits. And money market funds are now very different to how they were in the financial crisis. They're invested largely in treasury bills and in cash at the Fed, and that makes them much safer. So banks are going to be competing more for deposits, and that's going to squeeze their profitability, and it's going to be passed into higher costs of borrowing from banks. Proposals for reforms to bank regulations will also make bank credit more expensive. And we see that reinforcing the trend in the economy to use non-bank sources of credit. And these could become much more attractive as a source of financing for economic growth and job creation. We expect to see banks forming innovative partnerships with other parts of the financial system. And we think private credit could be particularly appealing for small and mid-sized firms which face limits on bank lending and don't want the deal sizes that public markets entail. The bottom line? We see these shifts benefiting savers and diversifying finance for borrowers, creating a more stable financial system and opening up potential investment opportunities.